Well, thank you everyone for joining us this evening for our special event. I'm joined My name is Michael Latrue with Parvis Investments. I'm joined this evening by one of my colleagues, Mr. Robert Blake, as well as Mr. Mathieu Rivet from BrainFinance and Mr. Jeffrey Lord from Lankin Investments. We have a pretty fun-filled night. Overall, filled with a lot of information and some interesting strategy overall. And as well, if you make it till the very end, you get put into a draw for a wine raffle, and we deliver wine right to your door. We find it's always a nice way to reward those that are willing to learn a little bit more about how some of the investments out there work. So our theme for the evening is uncorking tax efficient returns, a private capital tasting. So at the end of the day, it's not about how much your investment pays, but more about how much you keep in your pocket. So for those of you that are new to our series here at Parvis Investments, Parvis, we're out there to democratize access to information when it comes to private capital investing. We have a full online platform that allows investors to access information about a lot of different types of investments out there in the private capital space. We do have a lot of assets within the real estate markets, business solutions, even some dental practices, to name a few. Most recently, BrainFinance has joined our repertoire in the micro lending space, something that he'll be explaining very shortly as I pass the torch on to him. But lots of great investment opportunities out there. And up until recently, for the most part, it was usually inaccessible for most people. And Parvis, we're looking to change that just so that you can invest, learn about what's out there, and make some proper decisions along with some helping hands from people such as myself and my colleague, Mr. Blake. All right. So typically, when you're looking at returns, they can get pretty high at times. Assuming you're willing to assume a little bit of risk and a little bit of time frame involved. Shorter term time frames, you're looking at slightly lower returns, but overall, you're doing quite well. And most of these assets are non-correlated to the stock market, so you're not typically affected by the ebbs and flows of political situations and basically people panic selling all of their shares, which a lot of times, I'm sure many of you have seen it in the past, where you have market crashes for no apparent reason other than a bit of bad news. Oh, hang on, here we go. So what we have at Parvis, we have broad access. We have a full legal and compliance team to make sure that everything that we do bring to the table is compliant and follows the rules and regulations set forth by the various securities regulators in Canada. We do full KYC, so basically we learn about who you are as an investor and how we can best match you with the investments out there. And then we're also developing what we call a secondary market for several of the assets that we hold. In the event that you might not be able to get out of an investment through regular means, we can facilitate possibly getting you out through sideline investor acquisition. And then we have full transparency with any costs involved, as well as fees that come to be. Easy to use platform, all online. You can use it on your PC, your tablet. That's about where I would and use it. On the phone, it gets a little bit teeny tiny, but everything is there and full access to all the information that you would need in order to make an informed decision. All right. That being said, I will pass the torch on, but thank you for listening and learning a little bit more about Parvis. At the very end, there will be a couple of emails and QR codes that if you have other questions for Mr. Blake or myself, we're more than happy to get together and answer those questions for you. So without further ado, we'll get to the meat and potatoes of this evening's Uncorking. And first up will be Mr. Mathieu Rivet, our CFO from BrainFinance, and he'll tell you a little bit more about what it is that they do and how you can benefit from their services as an investor. So, Monsieur Mathieu, up to you.
Thank you very much. Good evening, everyone. As Michael said, I'm gonna talk to you about what we do at BrainFinance and why our opportunity is a great one. BrainFinance is a Canadian fintech focused on constructive credit for underserved customers. We operate an end-to-end platform, automated underwriting, servicing, collection. we've been at this since 2016. How do you want to work, Michael, to switch slides?
Yeah, just let me know. Just say switch or
Okay.
yeah.
So
I can. Here we go. Let me.
yeah, you can switch.
There we go.
So we've been at this since 2016. We're not a new company. We've processed millions of application, built proprietary data, non-prime and near-prime segments, and we disbursed over 1.6 billion historically in origination. So our group is a structure by three company at the moment. We have the holding company. Sorry, yeah, that's fine. Uh, so we have the holding company at top, BrainFinance, which is our tech company. We talk of ourselves by BrainFinance. Our main product is iCash, which is the micro lending services, and we have Earna, which is a credit card that we're developing at the moment, and I'm going to talk about a bit later. So next one, leadership team. We have a bunch of great professional people from all fields, finance, obviously, legal, engineering, what else? Compliance, data science. So full team of very professional people. So Canadian market, obviously, we operate on the Canadian market. We're not in the US yet. We operate, or our main segment are the non-prime consumer in Canada. So this is a large market. We say about 10 million Canadian are near prime or subprime. Our market is huge. It's a $250 billion market. That is how can I say, uh, regrouping people with score of 640 or below. Next one. So we say that about 50% of our customers are living paycheck to paycheck and $200 away less from insolvency. Most of our customers are using our services for essential needs like rents, car repair, utilities, and most of the loan that we do are $500 or less. I'm going to speak about that a bit later, but our loans are from $100 to $1,500. Average size is 500, but 55% are less than 500. Next one. So we operate in the short-term loans market since 2 years now. We're proud to say that we are the second biggest lender in Canada in that field. We are competing with companies that you probably know, Money Mart and Cash Money, which are or used to be the biggest one in Canada. Now we're just behind or chasing Money Mart. Those companies are much older than us. They're brick and mortar companies. We are solely online, so we employ much less people than them. So our costs are quite lower than them also. We operate under Canadian laws for short-term loans. It's heavily regulated in Canada. The way it works, we charge $14 per $100 that we loan. So let's say, for example, $140 for $1,000. It's regardless of the duration of the loan. The loans are, I would say, between 7 and 62 days. Average duration would be 30 days. So the $14 is the same if the loan is $7 or 7 days or 62 days. So iCash, our main product, like I said, it's a short-term loan, turn around quite fast, turnover for 30 days. Our main differentiators from our customers, we're the fastest lender in Canada. So customers come to our website, they fill the application. So under 10 minutes, if they're ready, if they have the information in hand, they can have the money in their bank account. So that's quite fast. Yeah, in a nutshell, we have about almost now 500,000 visitors on our website per month, almost 2 million contacts. Um, our time decision making is under 10 seconds with all our the technology that we have behind. Like I just said, less than 10 minutes filling the application. Once the customers click on submit, the decision if we lend or not is taken under 10 seconds. And when the decision is took, it takes 2 minutes for the customers to have money in their bank account. We are 380 employees, about 80 here in Canada and 300 in the Philippines, where we have a huge call center there. Obviously, risk management is the key to what we do. Near prime, subprime, quite risky sector. We have developed over time many models to predict the comport the way that customers will comport themselves. On that table, what we see here is the credit score uh, predicted by Equifax, which is the blue line. Not the credit score, but the risk that the customer will be delinquent by credit score. So you see that the scores of 300 to 500 is quite high, but our algorithm are much more precise than that. So we're able to predict the scores and the delinquency of our customers much better than them. So that's why we're able to uh, do business with that segment. Default rate, we can skip this one. Financials. So, like I said, we've been doing that since 2016. We have the stats here since 2019. Um, we are profitable since 2019. So, um, I mean, net income positive since 2019. So what we can see here, our revenues grow from 15 million in 2019 to 70 million 2025. EBITDA grew from 2 million to 15 million on the same period. Um, and origination, that's the money that we lend to our customers. So from 190 million in 2019 to 500 million almost this year, and we did almost 1 billion loans this year only. So we do about 80,000, even a bit more than that, loans per month now. I don't have a slide on net income, but that's worthy to mention. Like I said, we did break even around 2019. We did 5.7 million net income in 2025, and forecasted 7 million or budgeted 7 million for 2026. I did say at the beginning that BrainFinance is the tech company. I just spoke about iCash, which is our short-term loan product. BrainFinance is the technology behind that. So all the algorithm models, AI that's blended into it that enable us to analyze the customers, analyze the repayment habit, the spending habits, because we have access to this when a customers fill the application on our website. So BrainFinance is all the technology behind that enables us to build our own score and not use the Equifax one, and decide if we're gonna lend or not to that customer. 90%, even more than 90% now of our decision are fully automated. So all AI driven, almost no human intervention in the behind. Our probability of default is quite accurate at 96% plus. We do more than 10,000 data point analysis on every customer that comes in. So we have a huge models. In fact, tons of models, tons of data analysis that we do on each customers. So obviously, operating online require security and compliance. We want to make sure that we don't get breach. Even like we cannot afford to be down for even a few minutes, and we cannot afford to have a breach and lose personal information. So we have a huge emphasis on security, a huge department also on IT and security. I spoke at the beginning about Erna, which is our next product that we intend to launch this summer. We've been working on that since more than 2 years now. We already signed a deal with Visa, lots of other third parties. We're the last milestone that we need to launch the product is sign the final agreement with our bank partner, which is EQ Bank. So we've been working back and forth with them on that agreement. So as soon as this is finalized, we will be able to launch that product. So in the upcoming months. Uh, why a credit card? We think it's the next step in what we do. There's no credit card like that in Canada, like targeting the near prime and subprime. It's a huge market. It has a lot of potential. We are looking at some companies in the US, namely Mission Line and Avent Credit. I think that's the only two that we were able to find that are doing credit card for subprime. So we intend to be the first one in Canada to target the market. We have the data, we have the models, we have all the automation to be able to build that. So yeah, that's going to be our next product that we're going to launch sooner than later. So the goal is to open access credit to all near prime and subprime, improving financial health. So that's going to help us to build or rebuild their credit. So we truly think that we designed a solution that's going to address the needs of those customers. We can skip that one also. So the investment opportunity. So it's a 12% annual return fixed coupon paid monthly. It's secured by a deed of hypothèque. It's only 12 months, so it's auto renewable, but it's only for 1 year, so the investor can opt out. I was going to say at any time. It's not really true, but each anniversary of the investment, the investor can opt out, and it's backed by all the experience that we have in that domain. So I said that our debenture are backed by a deed of hypothèque in favor of Olympia Trust. The minimum investment is $1,000. Well, it's $1,000 per debenture for a minimum investment of $10,000. Like I said, 12% per year, payable monthly, and 12-year term, like I just said. Next one.
There you go.
So use of proceed. Why are we doing those debentures? So we want to scale the existing product, strengthen our liquidity, continue to build on our compliance and governance structure, and obviously help and launch the credit card this summer. So that's the main goal of why we are doing this now. Investor protection. I already said that we are backed by a deed of hypothèque in favor of Olympia Trust. We have a strong track record of payments, so we've been using those debenture investments since 2021. We never missed any single interest payment. We never missed any redemption for an investor that wanted to opt out. So we're quite proud to say that we're very secure and we don't want to miss any of those payments. We also are backed by a senior lender, so we have a main lender at the holding level. We have covenants to meet and to respect. So they're overlooking at us, making sure that we do everything correctly. So that's it about us. And yeah, I would be happy to answer any question.
All right. So I guess the first one was how would you differentiate yourself from Propel other than
Propel.
Propel being publicly traded,
Yeah.
and you guys are private? What would be another differentiator that you guys have versus Propel?
They're great. In fact, Propel. We look at them and we wish that at some point we'll be as big as them. Um, their product is a bit different than ours. They operate. I would say their biggest product is in partnership with banks in the U.S. Um they do also installment loans, which are on a longer term than what we do. They have like 30 days loan, but that's not what they do on it in their core business. It's more like 1 year loans with monthly installment payment. Our product is different. Uh, it's shorter, and it's most of the time it's a single repayment. So yeah, it's similar but different at the same time. We are only in Canada. They do only a small portion of their business in Canada. Um, but yeah, it's a good question. We're quite similar, and when we get bigger, we hope we're gonna be like Propel.
Thanks. Then
Um,
next question is: will open banking regulations? Do you see changes within your own business model and how it would operate, or
yes,
how it would
yes, we
impact?
do. In fact, we've been waiting for the open banking for quite some time now. I don't know if we're gonna see that in the short terms, but like I said, we hope. I would say our main difficulty now is um, all of our payments are automated. So customer comes, we lend money, but we predefine the moment that they're going to repay us. And the way it works, we go to their bank account and we take the money ourselves. They sign all the agreements to do so. Um, we have a default rate of about 12%. So that means that let's say 10 to make easy numbers. For 10 customers that we go and take the money, one don't have it. So open banking will enable us to look at the account in real time and not attempt to withdraw money if it's not there. So we're gonna we're gonna skip all the NSF fees and things like that. We're gonna be able to make sure that or monitor the bank account of the customers and withdraw the money when the funds are there. In fact, so for us that would be huge benefits to be able to have that open banking system.
Excellent. All right. We have a few more questions, but for the sake of time, we'll keep the questions and notes, and then we're going to answer everybody those questions via email. But one of the questions was, what's the rate that that you charge clients, and then another one was, what are the overall margins? I know the margins are very healthy. We'll send you the all those that information in via the email, so that we everyone has the same answer.
And how
But
long have you
thank
been in
you.
business,
Oh yeah,
Matthew?
and how long have you been in business, Matthew? 2016 or
Yeah,
19?
company was founded in 2014, and the first loan that we did was in 2016.
Yeah,
Yeah,
excellent,
fantastic.
excellent. All right, well, thank you so much, Mathieu. And all right, so next we have our good friend, Mr. Jeffrey Lord from Lankin Investments, or Lankin Apartment REIT. Sorry,
Well,
also
from
a division of Lankin
Lankin
Investments.
Investments is correct.
I've been working for Jeffrey with Jeffrey for a long time now, so I see him pretty regularly. An excellent opportunity here as well, several in fact, and some interesting tax advantages associated to it, which we'll get into after Jeffrey has presented his segment. So I will leave it to Jeffrey, and then yeah, every time you want me to change slide, just say.
Next, I'll give you a next. Well, no,
There you go.
that wasn't a real next. That was a test next.
Oh,
Well,
go ahead, take it
as always,
away.
guys, I appreciate you setting this up. Appreciate you including myself and Lankin. These are always great events Today, as Michael mentioned, we're going to be discussing the Lankin Apartment REIT. At Lankin, we have a number of different investment offerings. This is one of our newest funds that we offer, and it's definitely been the most popular over the last, call it year and a half. So I'm very excited to share it with you today. Next. So just a bit of background on Lankin. We're an asset manager. We're focused on acquiring, operating, and improving multifamily residential properties in core markets across Canada, apartment buildings. We have a great track record. We've been around over 15 years now, and we're happy to say during that time we've never lost a cent of investor capital, we've never missed a distribution, and we've never been in a position where we've had to tell an investor they can't get their money out. So that's something we're quite proud of. We've also grown quite a bit over that time. A big milestone that we hit in 2025 was $2 billion in assets under management, meaning that we as an asset manager manage over $2 billion worth of real estate. And that's comprised of over 6,200 apartments across 70 properties, again, in core markets across Canada. We also have over 4,000 investors invested with us today. Many of those are everyday retail investors who are invested with us through their RRSPs or their TFSAs. But we also have a number of high net worth and ultra high net worth investors we work with, family offices, and even some institutional partners such as pension funds and endowments, etc. So a very diverse investor base as well. Next slide, please. It's a quick overview of Lankin. Now we can get into the good stuff and discuss the Lankin Apartment REIT. And before we get started, I really wanted to highlight a couple of the big differentiators. I've been in this space for a while. I understand there's a lot of avenues for investors to invest in real estate across Canada, and more specifically in multifamily real estate. So when I was joining the team at Lankin, one of the big things I wanted to better understand was, are there differentiators? And if so, what are they? And luckily, Lankin has a number of very strong differentiators that really help us stand out in the marketplace. One of those is the markets we invest in. So we're very focused on core markets. These are markets that have really strong growth metrics, population growth, job growth. They're in close proximity to public transit hubs and other thoroughfares, and they have a lot of additional growth potential as well. We like these markets just because they've proven themselves. They have great track records, they've been resilient, and they're high demand markets. Secondly is the fact that we're active managers. You see a lot of groups buy apartment buildings, they hold those buildings, they wait for rents to go up, and that's essentially their business model. We're a lot more active than that. Our CEO always jokes that we're in a vanilla ice cream business, but we put chocolate sauce and sprinkles on top. So we try to make it a bit more interesting and try to add a lot of additional value for our investors. And I'll elaborate on that a bit as we go through the presentation. Another thing is the type of financing we're using. We utilize a fairly exclusive program through the CMHC called the MLI Select program, which allows us to lever a little higher and extend the amortization out on the debt that we're using. Again, I'll get into that in a bit more detail. One of my favorite differentiators is the tax efficiency of the fund. We've structured this fund in such a way that it's very attractive for tax-conscious investors, especially if they're high income, which is an important thing to highlight because it's in line with the theme of this evening's webinar. And again, I'll elaborate on that a bit more as we go through the presentation. Next slide, please, Mike. So what is the Lankin Apartment REIT? Lankin Apartment REIT is a fund that we launched in 2024, mid-2024. And it's a fund that's purpose is to acquire institutional grade multifamily real estate in core markets across Canada. These are buildings that have traditionally only been accessible to large institutional buyers, pension funds, endowments, people that can buy very large, very expensive buildings. So with this fund, we wanted to provide access to everyday investors to have exposure to these types of assets with a minimum investment of as low as $5,000. Markets we're focused on. So Lankin Investments has been primarily focused on Southern Ontario over our 15-year run. And that is the case as well with this fund. but we are starting to venture out a little bit into Alberta. So we bought our first 2 Alberta assets with this fund, one building in Edmonton and one just outside of Edmonton in Sherwood Park. Alberta is a market we're pretty bullish on. We think there's a lot of growth potential there. We're seeing a lot of interprovincial migration that's not just tied to the oil and gas industry. These are young families, young professionals going out there and laying down roots. So we're pretty optimistic about Alberta. With that being said, Southern Ontario is still our bread and butter, so to speak. Michael, next slide, please. What does that mean for investors? So I'll quickly highlight some of the terms around this investment. Total target returns are 14 to 18%. Those returns are inclusive of 2 components. Firstly, our monthly distributions. So we do pay a monthly distribution of 81 cents per unit. Our current unit price is $10.61. So that represents a yield of about 7.6%, which is 100% return of capital, most tax efficient form of investment income. The second component is the growth component. So as these buildings appreciate over time, that appreciation is reflected in your unit price, similar to a share price when you own a publicly traded security. And the way that we do those appraisals is we use third-party appraisal firms in order to come up with the value of the portfolio assets. CBRE is one that we use, for example. So these aren't valuations that we're pulling out of the sky. They are audited and they are through a third-party appraisal. So very strong potential returns on this fund. Great for any investor looking for growth. Also great for any investor looking for income. And I'm happy to say that in 2025, which was our first full year since inception for this particular fund, we were able to achieve a total return of 14.2%. So we're on track, and we're quite proud of that success that we were able to achieve last year. Next slide, please, Mike. As I mentioned, I won't spend too much time here, but we're very focused on primary markets. We like Southern Ontario, we like Calgary, we like Edmonton. We're not buying assets, in Moncton, New Brunswick, or Lethbridge, Alberta, for example. Those can be great markets, but they don't have the track record of the Greater Toronto Area, for example. And we like that track record. We like the fact that those markets tend to perform very well despite broader macroeconomic conditions. So for the sake of the fund and the sake of our investors, our mandate is to focus on those core markets. Next slide, please, Mike. Talked a little bit about NOI growth strategies, and what that really means is the fact that we're active managers. We don't simply buy buildings, wait for organic rental growth and appreciation. We've always looked at ways that we as operators can generate alpha and make these buildings more efficient. And there's really 2 pieces there. There's increasing the revenue of these buildings, and there's a number of things we focus on there, big or small. Nothing is too small when it comes to ancillary revenue sources. But I'll give a couple examples. For instance, we rent space on our roofs to telecommunication companies to put cell towers. We have partnerships with an insurance company, so if any of our tenants utilize their tenant insurance product, we're able to participate in a share of the profits. We have partnerships with groups like Rogers and Bell, where if any of our tenants utilize their cable or internet services, we get a piece of the profits. And again, that's not an exhaustive list. That's just a couple of examples. But another big piece is reducing the operational costs. And what we've really focused on, and a segment or a piece of the business that we really utilize, is making these buildings more efficient from an energy perspective. And you'll see some of those metrics here on the side. You'll see that through sub-metering our units and lighting retrofits, we're able to reduce our energy costs by up to 40%. Through our in-suite heat pump program, we're able to reduce our natural gas consumption by up to 60%. And through the installation of low-flow valves and fixtures throughout the buildings, we're able to reduce our water costs by up to 40%. And obviously, this is great from an environmental perspective. But as a business, it's even more importantly, has a very strong impact on our bottom line and our net operating income. These buildings, any sort of commercial real estate, multifamily buildings included, they're valued very similarly to a business, as opposed to where a single family residential home is not. So when we take these buildings and value them, the amount of net operating income that they're able to generate is tied directly to the value of these buildings. So that's why it's so important as an operator to focus on these things. So when you're in a good market, it's important, but when you're in a more challenging market, it's even more important, because you need to drive that value. You can't rely solely on the market. So this has been sort of a cornerstone of our business since inception, is driving additional value, making these buildings more efficient. Mike, next slide, please. Another thing that we do, and there appears to be some formatting errors with this slide, but I'll explain the gist of it, is another program I talked about that we utilize through the CMHC is the MLI Select program. It's not a program everyone can gain access to. There's a couple levers you need to pull, and the objective is to get as close to 100 points as possible. And the three levers are affordability, accessibility, and efficiency. We focus exclusively on the efficiency and the accessibility component. So making our buildings more efficient and making them more accessible. And what we're able to do with that is we're able to get preferential financing from the CMHC that allows us to lever higher, up to 95%. And we're able to extend the amortization period out to up to 50 years. With that said, the current loan to value on the fund is about 72%. So it doesn't sit at 95% or anything. But one of the things to highlight on top of that is we're eliminating not all of the risk, but a lot of the risk traditionally associated with higher leverage. We're not borrowing from a predatory secondary lender operating out of a strip mall or anything. This is government insured financing. It's fixed on a 5-year term at conventional CMHC rates, which right now are between 3.5% to 3.75%, I believe. And what we're able to do with that, because we're levering higher, is we're able to generate stronger returns for investors. The cash on cash returns are up to 3 times stronger utilizing this program. And it's a program we've become very proficient at utilizing. So this is a really important slide. We talked a bit about tax efficiency. And I'll start with one of the components, which is our distributions. All of our distributions are taxed as 100% return of capital, meaning that in the year you receive them, you pay no tax on those distributions. So they really are the most tax efficient form of investment income. There is an impact on your adjusted cost base over time as you receive these distributions. I won't go too in depth there, but that's something either Mike or Rob would be happy to explain to you in more detail. The second really interesting piece is the way that we've structured the fund. So most real estate funds are structured as REITs, they're trusts, and we have that structure in place. That's the most common sense structure for anyone using registered funds through an RSP or a TFSA to invest in the fund. But what we've done that's a lot different is we've created a second structure for the same fund, which is an LP or limited partnership structure. And this structure is very advantageous for any cash investors, especially if they're high income. And what we're able to do with that structure is we're able to take any expenses to the fund. So those can be debt servicing costs, mortgage payments, renovation costs, any expenses to the partnership, and we're able to proportionately allocate those to our LP unit holders each year via a T5013 tax slip. And what you can do with that is all of those expenses are characterized as losses on that tax slip for accounting purposes. And you can take those losses and you can apply them against your personal, corporate, or investment income to reduce your tax burden in that year and therefore hopefully increase your tax refund. So they act similarly to an RRSP contribution, but it really is a standout benefit and it can have a strong impact on your total net return after tax. I will highlight though, if you look at our historic or projected returns, we don't include this in those. So this is a bonus on top of growth, on top of the distributions. And it's something that really separates this fund from the other real estate offerings in the marketplace. Michael True, next slide, please. We're really at the end here, but I'll just highlight again that the success of this fund. We have done so well. As I mentioned, it's been about 18 months since inception for this fund. We've raised over $100 million in capital. It's been very well received in the investment world, both on the retail and the institutional level. We were able to hit a 14.2% total return in 2025 in a market that was a lot more challenging. We're hearing that rents are down, across the board, or they're flat in most major markets. And I think that success is really a testament to our mandate and the things that we've tried to do differently as operators over our 15-year track record. So yeah, we're really happy with what's going on with the fund, and we think it's a great opportunity, whether you're investing with cash, whether you're investing through a registered account, whether you're looking for income, whether you're more of a growth-oriented investor. We've really set it up in a way that it's really attractive to a large investor base. Thanks, guys.
Thanks, Jeff.
All right, we had a couple of questions. Let's see. What would be one of the big themes of 2025 were gates, like
We're what?
of the little white picket fencing.
Yeah,
so as far as the redemptions, if
sure, yeah, I'd love to touch on that. We have seen some private real estate funds gate across the past year or 18 months, call it. And, that's definitely something that's been really challenging for the industry. One of the things that we've done very well is we've been very strategic in how we've structured our funds in order to minimize the risk around gating. And one of the key things there is we have large investors, we have institutional investors, but we've siloed those investors outside of the fund. So no single investor owns more than 2% of the value of any of our funds. So we're not worried about an investor putting in a 10, 20, 50, $100 million redemption request and causing a run on the bank. We're very well protected from that perspective. We're very well capitalized. I would say another point is, over our 15-year track record, we have never gated any of our funds. And one of the benefits around the youth of this fund is it's only a year and a half old. No one's redeeming yet because they haven't held the investment long enough. And if we look at 2025, we had roughly $1.8 million in redemptions for this fund, and we raised over $68 million in new capital. So again, we're not at all concerned about a gating event, and we're very well positioned from that perspective.
All right. And another question we had was, what's the typical avatar for one of your renters? Like what segment do you typically rent?
Yeah, it differs on the market. We tend to like not super short-term tenants, but tenants that are somewhat transient, because we want to be able to capitalize on rental growth over time. We want to be able to turn suites, but we're certainly not going to rent evict anyone or try to kick anyone out. So a tenant that's going to stay 2, 3, 4 years is a great tenant for us. And I'll give you some examples. Students, for example, they're great. They're going to be there 2, 3, 4 years, and they usually have a high income parent co-signing. So those are great tenants. Another one would be, young families. Maybe they're renting a unit from us and they have a baby and it makes sense, but eventually they're going to need more space. They're either going to have to rent or purchase a home at some point. So they're another tenant type that would fall under sort of that 2 to 4 year time frame. So we like tenants that are sort of midterm staying tenants.
Excellent. All right. Well, we do have other questions, but we'll compile them all, and then we'll make sure to answer everybody's questions via email. It'll just make it a little simpler, and that way we won't take up too much of everyone's time this evening. All right. So now we're on to our last segment. All right. So one of the reasons that Robert and myself like working closely with both BrainFinance and Lankin is because all investments, we always look for great yield and returns. However, at the end of the day, your returns don't really equate to much if you end up paying a lot of taxes on them. So we try and find ways to help you keep more of those dollars in your pockets. And there are strategies out there that are available to all investors. Now, keep in mind, this isn't tax advice. We are privy to some very interesting information, but also we always work with accountants because everyone's tax situation is a little bit different. So always a good idea to have that conversation with us as well as with your accountant before you put any of these things into place. In the meantime, the next segment will only be a few minutes, but while we're going through that, if you would kindly type in your first and last names into the chat box so our kind friend in the background, Sarah, can take that note down, and then I will be adding it to a raffle wheel for the wine that we will be drawing at the very end of the segment. However, you do have to stay till the very end to claim your wine. Otherwise, I drink it. I'm just kidding, but you still have to stay. All right, so here we have. Oh, that's strange. My slide looks different here. So not all 12% returns are created equal. You can have different investment types because at the end of the day, if for those of you that do invest into the stock market itself, for example, you realize that you have interest income as well as dividend income and then capital gains, and they're all taxed a little differently, which can wreak a lot of havoc on at the end of your year. So when we look at certain strategies, what you want to try and do is you want to pair up investments so that some tax efficiencies of one can offset the interest income of the other. So if you look at, for example, investment A being a real estate trust, i.e. Lankin, they have a very tax efficient structure where when you're using unregistered funds, you have your distributions, and in this case you're at approximately 8%. You're looking at about a $12,000 return or cash flow into your pocket every year as a return of capital, which means there's no taxable income there. But then they also have the flow-through taxes or the tax losses that Jeff had mentioned. It's a magic little piece of paper called a T5013. It's a limited partner tax slip. You can definitely go verify it and look it up through CRA's websites. It is very much there. And this is an interesting tax slip because what happens is with some of the tax losses that the funds have, they can help pass those along to investors so that they can benefit from those tax losses themselves on their existing income. So when you pair something like Lankin like that to say a BrainFinance who generates 12%, or in this case here on a $100,000 investment, a $12,000 interest return, well, an offset of the taxes will definitely benefit you greatly because if you don't have an offset, a 12% return in interest basically equates to, after taxes, $5,640 in returns, which isn't terrible. However, if you offset those taxes, you keep the full 12, plus you have the other 12. In essence, enhancing your overall cash flow from a taxation perspective. So at the end of the year, when you have those conversations with your advisors, Robert and I mean, we'd be very, very proud to take care of your overall strategy, as well as with your accountants. We can help you build similar strategies where we're able to pair up different types of investments to maximize your return, especially if you're looking for recurring cash flow, but minimizing your tax burden as well. And this is something that is ongoing, which is something that we can definitely chat about in future conversations about how that T5013 benefits you on the long term. Think of it as almost like an RRSP that just keeps on trucking and keeps on giving without you having to contribute every year. You contribute once, and then it gives you that tax break every year as long as you hold the investment in place. So, and how does that look after a few years? Well, let's put it this way: if every year you're using this strategy, and you were to do it with these particular investments over 15 years, at the end of 15 years, you'll have generated just under $400,000 in recurring cash flow versus having just say one or the other where, on their own, they would have generated about $85,000. So it makes a little bit of a difference. So at the end of the day, you have to ask yourself, what kind of cash flow position would you like to be in? And again, you look at all of the different investments and you see how best do they work for you. And that's about it. So then I'll let Robert speak because he's itching to ask a question. I see him fidgeting there.
My only comment, Mike, if you go back a slide where you showed investment A, investment B, right there. Thank you.
Yeah.
Another aspect is when you're looking at portfolio design is investment A in this case, investment B in this case is a debenture debt. It's a different part of the capital stack when you're looking at finances versus investment A, which is a REIT. You are in an equity position. And so when you pair up two investments like A and B, B being a debenture, A being equity, the equivalent probably most of you are familiar with on the stock market is your advisor in mutual funds would say, client, you should have a 60-40 stock bond split. Well, this is an example here. 60% you could argue is your investment A, which is a REIT, and 40%, let's not lose focus of the debentures or the debt side and balance out your portfolio design. So I just wanted to add that.
Excellent. All right. So that basically brings us to the end. So we have most names here, but we're missing a few. If you prefer to stay anonymous, that's perfectly fine. But we won't be able to put you into the raffle wheel. So if because at the end of the day, it's I have to. Here we go. I just add everybody. All right. And then I'll just share the wheel. That way, it's legit. Everyone can see who's going to win. There's no questions about it. There's no favoritism.
Am I allowed to put my name in, Mike?
Sure.
No.
You're paying.
No. No, of course not.
Another quick point to consider: investment A and B. Jeff's time horizon in investment A in the REIT is 36 months before there's a no redemption penalty, whereas on Matthew's side on the debentures, only 12 months. So, when you start looking things collectively, maybe there's some short-term money you need access to, and there's money that 3 years you don't need, you allocate towards, say, investment A, the REIT. So you don't need to be fully liquid.
All right.
Look at that.
Last chance for everybody to get involved in the draw.
Look at Trevor F.
We have
Trevor F seems to have skewed odds there.
Yeah, well, I mean, it's all about who wants to put their name in the draw, right? So, I mean, we have quite a few attendees, but not everyone's putting their name in the draw. So, all right. So, going once, going twice. All right. I guess I'll just click and spin and see who's good. We have two draws, two wine boxes up for grabs.
God, those are great odds.
I know, right? Oh, Congratulations, Jenny. I'll be contacting you to let you know when your wine's gonna arrive. All right, and one more time now.
Parvis.
All right. Via courier will be. Pardon me. We have some sources for some vintage wine collections here, so you'll get 3 reds and 3 whites each. They'll arrive via courier. So we'll be in touch with you to acquire your addresses so we can get that to the right door, because you definitely don't want them to show up at your neighbor's house. But with that being said, let me stop sharing the screen here. So as we had discussed earlier, we will be answering all of those questions that we did not have time to answer this evening. We'll be answering them by email and sending out the transcripts to everybody involved. But if at any given point in time you wish to you have other questions for us, please don't hesitate to contact us. Oh, actually, that reminds me, I do have another slide here.
Yep.
With
reach out.
There we go.
We can reach.
Feel free to take a screenshot and then QR code us. But at the end of the day, Robert and myself are here to help you make wise choices in your investment endeavors, and answer all the questions that you have. And if we don't have the answer right away, well, we have Mathieu and Jeffrey that are always a speed dial away to answer any and all questions that we might not have the exact answer to. So that being said, thank you everybody for joining us, and we hope you enjoyed the evening. And we will have similar events throughout the year with varying themes. But we thought, taxes is one of those things that people deal with on an ongoing basis. So we thought it was a good idea to sort of show them some aspects that may be beneficial for their portfolio overall. But thank you again, and have a look.
Thanks for having us.
Thank you.
Thank you, Matthew. Thank you, Jeff.
Yep. Thank you, Matthew.
Bye.